What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is June 22nd of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we're going to be talking about one of the biggest mistakes that people make when trading or investing in financial markets, and especially in cryptocurrencies, as it tends to be a much more volatile and therefore emotional market. And it's the concept of going all in, trying to use all the available cash you have to pick bottoms and pick tops in the market, buying in at what you think is the absolute low of the market, at the lowest potential opportunity, and exiting the market at the best available position, and therefore selling right before the overall correction starts. This mentality can cripple a lot of investors, and not only that, it limits their potential returns by doing alternative strategies when riding bull markets and therefore taking profits during the start of bear markets. So we've got a lot of things to dive into in today's video. I think this will be valuable for a lot of you. If you enjoy it, share it with a family member or friend in crypto. Consider dropping a like, and stay tuned as well, because we've got a sponsored review of the Kava network later on, one of the exciting layer 1 protocols we're keeping an eye on. So stay tuned for it. You won't want to miss it. All right, let's go ahead and dive into this conversation, guys. Now, I understand a lot of people have been feeling the FOMO here. It's amazing how we've seen a 180 in the emotions of the market. Back a couple of days ago, or just a week ago, everyone was thinking that crypto is absolutely dead, the macro environment is really setting in, and that we should see Bitcoin at much lower levels. Now, as per usual, if you check crypto Twitter or crypto YouTube, you'll find a lot of people flipping their tone and saying that we're absolutely set to go higher. The bottom is in at $17,600, and it's easy to get caught up in those emotions, because if we take a look here, Bitcoin did make a solid rebound here off of the lows. It came from around 17,600 all the way up here towards around $21,700, a 23% return in price. And it's easy to get caught up in the emotion and try to counter trade when you were probably short or bearish previously. Again, I'm going to focus here on why people get caught in this trap, and it has to do with two things. It has to do with impatience, right? You can pretty much not guarantee anything in life other than the fact that people are going to be impatient on things. And second off, the next best thing you can guarantee is that people are going to get greedy. Now, it's not to say that if you're trying to pick the bottom here that you're either of those two things, right? I'm not implying that here. If you bought Bitcoin in this case or put a little bit into the market, that's not the problem. And we'll talk about the best methodology towards approaching bottoms and tops in markets. And trust me, I learned this from experience through my mistakes, not just in the past, but during this cycle, right? With a little bit of self-reflection. The biggest problem is that if you try, for example, after one of these kind of rebound candles, where over the 4-hour chart here we saw a 7.5% move in Bitcoin's price, and we started to trend higher afterwards, you might have started to add entries here, right, within price. Now, I'm not talking about the recent correction here. Yeah, you might be a little bit down on your money, maybe you're neutral, maybe you're a little bit up, right? But what I want to talk about is the potential scenario that price could start to roll over here. Now, the reason why it is more likely than not that we are going to roll over and probably continue seeing lower price action, and why it's foolish to try to pick absolute bottoms, is because of the signs that we find during capitulation. A lot of people think that markets move in absolutely vertical directions, that it's either collapsing dramatically, kind of like what we've seen here over the past couple of weeks, as we've been seeing momentum to the sell side pick up, but then people think that right afterwards it's just going to be an absolute complete reversal, that it's just going to absolutely go vertical. And while you can have short squeezes and you can have things that do drive up prices to some degree, markets usually don't move like that. And if we were to have seen a short squeeze, the likes of which many people are calling for, it would have materialized by now. Most of the kind of heavy shorts that were building positions here are probably out of their position or knocked out, right? And they start to see that sign of strength moving. They're either forced out of their position or they're getting out, right? So that's an important thing to keep in mind here, is that markets don't just absolutely go in a V-shaped recovery. And I want to focus on a really great indicator here that I think showcases an example of what capitulation looks like, and why, out of those 2 points we brought up earlier, patience, right? Not being impatient, but rather patient, can pay major dividends. It can even give you a better indicator of getting in not only closer to the lows, and generally in that matter, getting a better price, right? So let's go ahead and take a look at the previous cycle here, right? So I want to take a look at where we are now in the previous cycle. Right now, we are very far extended here from the 4-hour 200 EMA, okay? And I want to use this as an example. You can take a look at the hourly EMA, you can take a look at the 4-hour, you could take a look at the daily moving averages, right? All these metrics are going to be valuable to some degree to understand here when capitulation, real capitulation has come in. But I find that the 4-hour time frame is really good here for this. Take a look here at the correction that really started back here in March of 2022, right? We could take it from the absolute top here, but I want to focus on really, again, these big gaps down in price here. We've gone from around $47,000 here to the absolute low of $17,600. Since we broke through the 4-hour here, we started to treat it as resistance multiple times. We came up here, tried to have a retest here. We even got above there, but soon after fell through. And then afterwards had many times where price tried to get up, couldn't get up to that 4-hour, and then collapsed heavily lower. And then after some sideways capitulation here, what many people, including myself, thought maybe might be a potential bottom in the market, right? Again, we didn't go absolutely all in or anything, but we were waiting to see if price could start to recover here. Price came back up, treated the 4 hours resistance multiple times, and then collapsed lower here. Now, all the while, it's not a simple means of getting above the 4-hour here, right? Like we did back here in April. It's a matter of getting above there and staying on top of it, using it as support here. Now, the reason why these moving averages are so important is that they're not only watched by a lot of investors, but it signals that there is a potential trend shift when we start to utilize these MAs as support or resistance, which is counter to where they've been using them as before. So ideally, what we want to see here is that whether rather than it being used as resistance here, where people are taking profits and market order flow is starting to push price downward, right? We would like to see essentially the price would get above the EMA and start using it as support. So imagine this would be the EMA here, right? We've got the price resting on it as support. And again, the longer you can hold above that MA, and start to signal that price does not want to come down. Buyers are now using this as a range of support. You are likely entering into the late phases of a bear market and therefore capitulation. Let's go ahead and take a look at history here. If we go back to the previous bear market, now, there were a lot of opportunities where price during a dramatic wave of sell side pressure, you had a lot of days, for example, like the one here on November 14th, where Bitcoin was down 6%, continued to drag down even lower, for the rest of the days afterwards. And then we saw a rebound in price and people thought, oh my gosh, we're starting to get a cupping here within price. We're going to break out higher. And then afterwards, again, we collapse lower here, right? And for multiple weeks going into the month, the late month of November and early December, we had many rebounds in price. We had a double bottom here on the 4-hour chart and even an upswing in price where people were thinking, oh my gosh, this is the absolute bottom. But then we, of course, rolled back over here. It was only until we finally made contact here with the 4-hour MA, right? Notice how price is starting to play tango here, right? We started to see a little bit less sell side pressure on the market. We still dragged down here, right, to this low range here, right, in February 2019. But afterwards, what we started to see here is that price started to turn the 4-hour into a range of support. Now, I know some of you are probably saying, hey, Nick, wait a minute. As I'm looking here at the chart here, I'm not getting the absolute bottom if I wait for the 4-hour MA. That's not very fair. I want to get the absolute lows in this case. I want to benefit best, right? We need to face the reality, guys, that we will not pick that absolute bottom. Your chances of picking that absolute bottom or the absolute top during a bull market are somewhere in the range between the exacerbated range of winning the lottery and picking an altcoin that's going to double in value overnight. Both of which are not very common and are a fool's gambit to try to do, right? Because what we could very likely be in right now is in this kind of price range here, where we're up here in the 4,400 range, trying to enter in, trying to pick in what we think is the bottom here, when in reality, price drags on lower. And it's not a matter of just getting a price that's higher than the lows here in this case, right? We're not here to try to promote picking bottoms. The problem with this is that you're going to enter in thinking it's the bottom, and then price goes down another 20% and you start to counter trade yourself. You start doing exactly what the market makers, what the institutions who need you to trade emotionally know you're going to do. And I'm not speaking about you particularly as a viewer, guys. Don't take it personal. All I'm talking about is the common mistakes that many people, including myself, have made over their history in trading. And until you can learn to reflect on that, know how the institutions are going to intend that you're going to trade and invest, only then can you start to trade and invest better and therefore make better returns and less mistakes. This is your money we're talking about, guys. I take it very serious here. I want to do my best to help you navigate that. And the important thing that I want to propose here when we're talking about price is rather than trying to go all in at a certain price here, we can see that capitulation in most typical bear markets, not just here in the previous bear market, but also in previous bear markets in the past. If it'll give us the price action, we might have to go here towards the daily here. You can see, I gotta actually bring up the other pair here. We'll bring up the Bitstamp pair, right? Turn off our drawings here. We can see that for a long period of time, the market remains in capitulation territory. What you can start to do if you think that we are in the later phases here of a bear market and we're at exacerbated levels is you can start to dollar cost average. You can just start to slowly put a little bit in each week. Where, for example, if you think that we're in the last couple of weeks before the trend's going to start reversing according to history, or the last couple of months, have a time window or between your income and the cash that you have on standby, you can start to average into the market, maybe $200 every week or every 2 weeks. Depending on how much money you have, it will vary. But allowing yourself to not stress about picking the absolute bottom and averaging in towards a nice, smooth, low price in the market, which will more likely than not give you an opportunity to have an average lower entry than just picking a bottom right now or trying to pick a bottom. It's going to bring a lot less stress. It's going to probably give you a better entry overall. And on top of that, you're not going to get emotional about it. Having, for example, $100 or $200 in the market versus $2,000 is a lot less emotional, right? And if you can start to enter in over time when price is starting to get more and more neutral and less fearful and the momentum to the sell side is weighing down, you'll start to feel pretty good about your entry. You'll start to realize, hey, I'm probably getting in at the right time. And all I got to do is simply keep to that rhythm there and wait for the trend to start to reverse. That's the key goal here. We can even see here, taking a look at the daily, right? Again, another great example here, how price many times failed to get above and maintain a relationship of support above the 200 EMA. And only until here, when we got this pop-up, and I remember this on April 2nd here, when Bitcoin's price popped up here. I think it was April 1st. It might depend on the chart timing here. But April 1st, April 2nd, when Bitcoin really popped up here, this was your telltale sign that the trend was ready to start reversing. And I think for a lot of people, again, back to that point about emotions, people are in a position they're thinking like, I really want to be able to ride the asset when it's moving. I want to make the gains in this case, and I don't want to be sitting around a lot, right? If you're one of those types, right, I do encourage just being more patient. But again, maybe you wait for one of those key signs here that signals a momentum shift here, like a cross of the 200-day EMA. That's also something that can be very valuable. Same goes here for Ethereum. We're very far away here from, for example, the EMA here, to where a lot of people want to try to pick bottoms, catch a falling knife, and all the while that can be good for maybe short-term swing trades. You got to know how to take profit. And again, if we take a look back at history, we're going to see here that the bottom didn't just set in and then go absolutely vertical, crossing that 4-hour 200 EMA. It came up here many times, retesting it, rolling back over, only to have a long-term substantial consolidation wave, right, where you didn't have to rush into it to get a good entry. And at that point, you're probably going to get a much better entry than trying to catch a falling knife when the sell side pressure, the momentum is still strong. It's still fearful, especially considering the macro environment that everyone's been referencing. Okay? Now, I want to go ahead here and talk a little bit about some of the key charts here in the market, kind of my sentiment around things here. If we take a look here at the altcoin market, this is again another thing that I want to emphasize to you guys. We've seen some renowned strength in the altcoin market, and all the while, yes, looking back on it, we wish we would have taken profits on altcoins earlier. What I love seeing here is the strength against altcoins versus BTC. We've come up back where we were around May 11th. To put it in perspective, we're right around the capitulation range of May to August of 2021. And I want to clarify here, some people might have misinterpreted, or I might have misspoke. We didn't sell out of our altcoin positions during this correction. I was referencing back to January of 2018, back during the previous bull market, like previously, right? For this bull market here, we're still exposed to a lot of our altcoin positions. And to be honest with you all, I wouldn't ignore the fact that we've had a nice rebound here, nice relief rally for altcoin valuations. It might be a good time to take some chips off the table, to de-risk. I think this is probably the smarter thing to do here. Yes, we could see an absolutely vertical rebound. You know, again, what we were just talking about earlier, some people think things are just going to go absolutely vertical and recover, and we're going to recoup these losses. Yeah, maybe. But what more likely than not is going to happen is that, like here, for example, and you can almost see it playing out on the chart, whereas the 200-day was a support range here, 200 EMA was support for altcoins, it's probably going to serve as resistance. And altcoins will probably hang around here, then try to tap up against that 200 EMA, and then probably get shot down like it's done previously before. All right? We've seen this happen many times in the past here, where the 200 EMA or the 200 EMA play as some form of resistance, right? I'm not saying it's an end-all be-all indicator, but again, a great way to start to see here and keep your emotions in check here in the market is to look at some of these time-tested indicators on longer-term time frames, all right? So again, we want to keep conservative here, de-risk a bit here, and make sure that we aren't overexposed here, especially considering that things could get worse. Now, some other things I want to talk about here, again, like in the sense of long-term entries into the safer plays like Bitcoin and Ethereum, right? We are in that typical capitulation territory. We are getting down here towards a range of net unrealized profit or loss here, where the market has mainly realized losses. And we have to see here again that over time, we're likely not going to have the kind of exacerbated levels we had in the past. We are probably getting close to that bottom range here over the next coming weeks. But again, that bottom could be the difference between maybe where we are now at 17,000 and, or well, actually now more around $20,000 and as low as 14K, right? That's kind of our target range. That's the level we're watching for. Again, it's not the absolute low in this case that I know for certain is going to happen, but it's a range of probability here. And when you're dollar cost averaging, what's really great is that you're more likely than not going to be getting that nice discount range than trying to go all in at this price. In that case, you're betting that you know how to pick the absolute bottom here. We know that this is a period, again, as we've emphasized for the past week or so, since we really got into those capitulative lows at 17, 18K, that this is DCA territory. This is the favorable environment here. And vice versa here, when we start to get overbought here, where net unrealized profit and loss is high, those are the periods of time where over, say, a month or two of all that optimism in the market, again, we don't have to pick the absolute top, and we're not trying to, we just slowly start to average out. Every week, we take 10% off the table, 10% off the table, 10% off the table, right? In total terms from the original portfolio, and then you're back into cash. And you know what? Yeah, you might miss a week of upward price action. Yeah, you might miss a month of uptick in price. But you know what? You're liquid, you're in cash, you took profits, and you could walk away knowing that you made some great returns after dollar cost averaging from the previous bear market. And that's what we want to do. We want to repeat this cycle because we know the vast majority of people won't do it. We simply know that. We have to make sure that we're on the right side of the trade. There's nothing selfish about that. You're just thinking in your own interest and making sure that you come out profitable. It'd be silly to try to trade and have it be basically going against you. Take a look at the MVRV ratio here. Right, we're taking a look, guys, as well at Crypto Quant, which is our data science partner here on the channel. And along with that, they've got a lot of the time-tested metrics here, like the MVRV ratio here. We're entering back in again towards this capitulative territory here. Another sign here, and again, emphasizing on the point here, how capitulation can last for a long period of time. Right? Take a look back here at 2015. It took nearly a year to get out of this capitulation here. Around 10 months for price to finally start trending higher here. your emotions and a 10-month window can be pretty intense. And that's not, again, an insult to you. It's us as humans, right? We always want to see things going our way, going in favor of what we assume price is going to do when we make an entry. We want to stand by our convictions, but in reality, it doesn't always work like that. And more painfully, rather than not, you could probably assume a lot of people were worried about the moves here, bought during heightened periods, sold during these lows, and missed out on a lot of great upside from Bitcoin going from around $150 to $200 all the way up to $20,000 into where it is here today. All right? We don't want to get caught in those emotions. We do not want to get caught in the emotions. If you guys are interested to get access to these kind of charts here in Crypto Quant, there's a lot of great community charts through the Pro Chart feature where community-made metrics allow you to start to see here when we're getting in towards kind of capitulative or trend reversal areas. Like, for example, this is the realized volatility tool here, where we can start to see when there was major trend shifts in regards to price here. We can see the spike up in volatility into the capitulation of 2018. We can see as well that volatility plays both ways on the upside here, the mid-cycle rally and therefore correction from 14K to 3K. And on top of that as well, during the May correction in 2021. And looks like very much it's going to be another retest here of this 150 point range on the implied volatility on one or two last remaining sell-offs here in price. Right? And this is, again, one of many tools you guys can get access to if you guys sign up for Crypto Quant. We've got a link down below in the description where you guys can get a discount signing up there and access one of the many plans here in order to get access to the different charts that they have. I love some of the metrics here that the community has put together. This is one of my favorites here as well, the take your buy sell stats. You guys know with Bookmap, we've talked a lot about market order flow. And I think what's really interesting about it is that it can start to signal here, depending on how much of the taker volume, basically who's making market orders essentially to buy at the best available price or sell it at the best available price. We can start to see here that when there's a lot of heightened amount of buy side pressure here, right? This is when we start to move higher and vice versa here as well. This is generally when we want to sell, when we have the kind of exacerbated highs in price here, and we start to see stagnation in price as well at these highs. We're getting very, very close to yet again an opportunity where it might be a favorable entry here. Now, there's a lot of things we're going to be keeping an eye on here over the coming weeks, guys. But the lesson for this video is this. Simply focus on dollar cost averaging. Don't try to pick absolute bottoms. I can promise you all, we want to feel like market wizards, but in the reality of it, we're just humans. I'm just human. I think one of the biggest problems that we actually made in this cycle is kind of the counter opposite of what we're talking about today. All the while, we did dollar cost average. We did enter in at those capitulative lows as we were watching the historical corrections back in 2018. And we will continue to do so here in this bear market in 2022. All the while, that is the case. I think one of the biggest mistakes I made in this cycle is that I didn't slowly exit out during a lot of the euphoria back in May and really April and March of 2021. I was of the mindset that, like, this is so early on in the cycle. We should expect that we would have another wave going forward. And if I would have been disciplined, and if I wouldn't have let that train of thought get to me, and I would have taken profits along the way, 10%, 5% every week, I would be much richer in cash here today, ready to buy the lows. And that's an important thing to learn from. It's important to admit to mistakes like that. We have to learn from those kind of events. Anyways, guys, I hope this video has proven valuable for you all. And on top of that as well, let's go ahead and dive into the review of Kava Network, which is one of the interesting layer 1 protocols we're keeping an eye on during this correction in the market. Alrighty, everyone. So in today's sponsored review, we're going to be taking a look over a protocol that we've talked about for a long period of time here on the channel, as far back as 2020, and it is no other than the Kava Network. Now, you guys might have seen some of our recent news mentions that we've had on the channel talking about Kava and some of the big announcements that they've released as of recent, but I have to say it's one of the more interesting approaches that I've seen in the Layer 1 ecosystem, combining two of my favorite Layer 1 protocol developer frameworks, the the Ethereum virtual machine, originated from Ethereum, but also used in other alternative layer ones like Avalanche, and also combining the developer tools and framework that's utilized for the Cosmos SDK, for the Cosmos network. These are two of my favorite frameworks and two of the most popular developer frameworks to build decentralized applications. And Kava is doing something pretty bold. They are combining the framework utilized to develop both applications in each of these ecosystems, combining them into one shared network where assets and liquidity from both Cosmos and Ethereum can start to interact in one single network with high rates of transactions utilizing Tendermint consensus, which originates from the Cosmos network. So imagine the ability to interact with Ethereum-styled applications coded in Solidity, as well as applications built within the Cosmos framework, all within a highly scalable network that allows you to interact with liquidity from both sides of these protocols. That is what Kava is offering here. And it's a really interesting value proposition. And I think in this case, really, we have to call it what it is. It's a very exciting experiment here, because what Kava offers here, as we'll dive into the content here, is that it offers an ability to drag liquidity from both Ethereum and all the alternative layer ones utilizing the EVM framework, as well as the Cosmos ecosystem. These are two of the most rich ecosystems when it comes to altcoins, stablecoin liquidity. Bringing it all into one simple network can almost make Kava a vortex of liquidity. And I think that this is a really interesting chance. It's, again, whether it's a 10-20% chance, and I remember talking to Scott about this, who's the founder of Kava, the current lead of the Kava Foundation. He's emphasized this point here that if you can actually build this network that allows people a wide range of ways to build value in the ecosystem for people to use it and to drag in this liquidity, it can make Kava a really powerful network here. So again, as we focused on here, it's a co-chain architecture. People are able to bridge liquidity over time from the Ethereum ecosystem and Cosmos. And we'll talk a little bit about how Cosmos is coming down the pipeline soon. Ethereum was the first major network, as it is the largest that people are familiar with. So you're going to be able to bridge in these different types of networks in their liquidity, the respective coins, and utilizing the power of Tendermint consensus in order to make it highly scalable. Now, I do want to spend some time here to talk about the Kava Rise program. Whether you're a developer or not, this is a serious program of interest here, because all the while there are a lot of, for example, liquidity incentive programs in the crypto space that encourage people to bridge liquidity from maybe more popular chains like Ethereum into a new alternative layer one. There's not a great amount of developer incentive programs. And one of the biggest problems that you find here with cryptocurrency layer one protocols, especially a lot of these platform plays, is that they tend to be really owned by a lot of VCs or a lot of people who really don't have that ability, even if they wanted to create a lot of value. What makes a chain valuable is the developer applications, the apps that you use in order to take existing liquidity you have today and either earn yield, swap to another asset, or do some other form of DeFi-related activity. And that's where the Kava Rise program comes in. Scott and the team had an idea here that the network itself should be owned by the developers who built the value on the network, who have either been able to build applications similar to the ones we've seen before or entirely new ones that bring TVL and value towards the network. And that's what the Kava Rise program is all about here. Kava Rise here is focused on leaving $750 million of Kava tokens, otherwise in this case 200 million Kava coins, up for developers who build applications on the network here. You can simply go to the website here, submitting your project, building within the popular frameworks of Cosmos as well as Ethereum, and enter in to potentially be a part of the program. And what's really cool is that it's done in a structured way. Essentially speaking, the higher your TVL, the higher the value your protocol builds, therefore you will get more share of that Kava Rise program. And it's something that's happening constantly over time. You don't have to enter in right away. It's something that, again, if you want to come in a couple months down the line or a couple weeks down the line, building up your developer skills and getting familiar with what Kava has to offer, you can contribute your applications. And it's going to be something, again, that over time, around 60% is going to be going towards developers and around 37.5% or 40% to stakers. 0% will be going to the team, VCs, or a strategic reserve for the Kava network. That is really exciting. A network owned by its developers and its stakers, people who believe in the value of what Kava can build. Now again, You guys have to understand here again, if you want to participate in staking or you want to build applications, understand that Kava is volatile in this case. The asset can go up or down in value over time. But what's so great about it is that unlike a VC who's much more monetary incentivized, in this case, we have developers who are building the value, being rewarded for adding value to the network, bringing people into the ecosystem. And I think that that's a really interesting thought experiment here. So I'm excited to see how it plays out here for Kava. Again, there's no guarantee of anything here, but I think it's a really interesting focus long term. The fact that they were willing to dilute a lot of their ownership as a team and the general network in order to build this incentive program for developers is very exciting. There's a lot of great details that you guys can dive into through their Medium article, and you guys should also as well follow them on Twitter. I have a link down below in the description that will take you to their Twitter where they have a lot of their updates. Give them a follow and you'll find a lot of really great pieces of information. One other good place on the website you can dive into is the roadmap, the Kava 1.0 mainnet launch, which we talked about here on the channel back about a month ago, launched back on May 25th. And since then, they've not only launched the Ethereum bridge, allowing for liquidity to move into EVM compatible applications within Kava, but on top of that as well, liquid staking has gone live. They've also launched their GameFi NFT incentive program, bringing in a lot of the gaming play to earn games as well as NFT projects to come over into Kava. And on top of that as well, there's a lot of other things coming in Q3. The launch of the foundation, COSM WASM support, allowing for the development of and also deployment of Cosmos applications within the Kava network. And outside of that as well, also the BSC bridge, allowing for one of the most popular alternative layer ones by market cap and liquidity and users to bridge over into the Kava network. Again, this is really exciting stuff here. And long term, they have the ability to bring Bitcoin in as well as a lot of other networks. And this is where things get really interesting. See, one thing that's a bit misleading here, or I think at least a bit short-sighted, is that all the while Kava is focusing here on mixing in the Ethereum network and Cosmos. This is just the beginning here. It's important to understand that everything is bridged through Tendermint consensus. And what Kava essentially wants to do long term is, again, back to that point I talked about earlier, I think the best metaphor for it is become a vortex of liquidity, of applications, to be a central network, essentially, if you will, for all activities to come to. And again, all the while, it's a big bet. Imagine being on a network where you're able to interact with Bitcoin, you're able to interact with the ecosystem of Cosmos applications and liquidity and altcoins, as well as the Ethereum network or Avalanche or BSC, right? Once you start to get to that point here, you really have a chain where you don't have to hop from one network to another. You don't have to constantly keep bridging from one chain to another to access certain features with your liquidity or your positions. Essentially, you can have one singular home for these applications. And ideally, long-term, one network where when a user uses Kava network, they won't have to leave to anywhere else. The liquidity will already be there, the applications will already be there, it'll be one singular network. And again, while it is a big bet here, I think this is really exciting here long-term. So you guys can definitely keep in tune with the roadmap on the website, dive into a little bit deeper. But outside of that as well, if you're interested as a developer, you guys can definitely dive into the developer docs, which are on their website in the developer section. You can dive into the GitHub to see what they're actually building here. Join the Discord if you guys want to be a part of the ecosystem or developer here, with others in the ecosystem. If you have any questions to learn about the Kava Rise program. And as well, if you're looking to build some testnet applications, they also have the Kava Pioneer program, a smaller version in this case, allowing a lot of people who want to build applications, test applications on Kava to enter in for a chance to win, in this case, a portion of 100,000 Kava tokens that have been set aside for testnet developers. So again, there's a lot of great ways that you guys can get started here. And I think what's so exciting about it is that so far already on Kava, they've already had a reach of $5 billion in TVL with over 50 protocols. This is back just over a week ago here. So I'm excited to see how things have been growing here since then, but I can only assume it's only been up overall for the network here. And it's incredible to see this happening during a bear market here, right? And I think it's why, again, Kava as a token has started to hold out quite well, even during this period of time here. We've seen that its TVL has surpassed that of Tezos, a blockchain that was a predecessor to it for a couple of years. It had been out there, in the crypto space since 2018, and even more TVL than Algorand as well, another alternative layer 1. So if we're already starting to see Kava's incentive program drive liquidity and applications fast on a lot of these networks, I think that's a really interesting telltale sign that it's something we have to keep an eye on. We can't ignore. So again, all in all, I'm excited to see how this goes. I'm excited to see the Kava Rise program. I'm excited to see how Kava has evolved as a project since we talked about in 2020 when it had a different approach and kind of different means of building value within the market. And again, all the while here, I'm excited about these things. The one important thing I would say here to keep conservative of is to see whether or not here we can really start to see a lot of new organic development within the Kava network. I like this idea of bridging in liquidity and applications into one framework to ease the process for users to use blockchain technology. But I really want to see if this is going to be able to spark, especially with the Kava Rise program, the development of new unique applications and new potential opportunities that just weren't available originally on these traditional layer 1s. That's what I'm excited to see long term. We'll have to see how it goes. But if you guys enjoyed this video, consider dropping a like, leave a comment down below if you guys have any thoughts on the video today, on what we talked about as well, whether it's about Kava or what we talked about dollar cost averaging and also dollar cost exiting out of the market, right? There's a lot of exciting things going on in crypto, guys. Even though we've been through these difficult times, we've got to look upwards. We got to think long term. But until the next video, thank you all so much for watching, and I'll see you all in the next one. Take care, everyone.